Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I'm your host, Dr. Daniel Crosby, and I am joined today by Dr. Joseph S. Moore. He insists on being called doctor. There is the author of the forthcoming book, How to Get Rich in American History, 300 Years of Financial Advice That Worked and Didn't. Of note is that Joseph is my new favorite guy. You ever meet someone and you immediately vibe with them and know you're going to be friends? That's what happened to the two good doctors on this call today. We had lunch the other day, talked about trying to make a living when you have a PhD in something useless, and we talked about the process of writing a book. So glad to have you here, man.
Daniel, it's great to see you.
Look, we did it. We have advanced degrees in some of the lowest earning fields you could ever possibly major in. And look, we made good.
So when I was researching the book, as you know, I self-experimented with so many things. Like, if people did this in the 1800s, why can't I try? And so of the many things I researched, one was like 1960s, 70s, like real estate investors. And I, bought some real estate. And after a while, there's these kind of tack tricks that you can do, right? We're perfectly legal, but to do it, you really need to be worth something, right? Big real estate investors do it on everything they own. I call into one of these places and they're like, "Oh, Dr. Moore." And they talk to me and they're very excited that I've called to inquire. And then they find out that I have a PhD in history and how little I make. And they're like, "We don't think we're a good fit for your portfolio."
Like, oh, we thought you were an anesthesiologist.
Yeah. Exactly. Yeah.
Yeah. No, but you did it. You showed them. So we're going to jump in today. The book is awesome. You are awesome. But I want to talk about the American dream first, because this is something that I think is very much part of the zeitgeist, very much part of the conversation right now. And you say that, due in large part to your upbringing, that you were once deeply skeptical of the American dream. And I think skepticism about the American dream is very widespread right now. That's kind of what I'm hearing. After studying 300 years of history, making sort of an empirical study of this, what is your current view with respect to the American dream? Is it alive? Is it broken? Is it misunderstood? Where are we at?
So I can find people saying the American dream is dead about 250 years before I can find the phrase American dream. So this idea that everybody before me had it good, by the time I got here, it's over. That idea goes back to the 1670s. Is the first time there is an uprising in Virginia in 1676, not 1776, 1676. They burned the capital of Virginia to the ground because they said everyday people can't get ahead anymore. It was all the lucky people who got here before us. And this just repeats over and over. In the 1800s, there's these speeches given that the rungs on the ladder of success were sawed off by the people who got ahead of you. And in the 1980s, there's headlines, big headlines in all the newspapers saying, it used to be good, but now the baby boomers will never have a chance to retire. How did that work out? Right? Like we have heard all of this before. Now, to be fair, it is a quite seductive message. And I get that. I mean, here's my background. My family were labor organizers in the South. You know how hard it is to be a communist in the American South? This is not normal, right? But in the 1920s, the Communist Party sent organizers into the Carolinas and taught mill workers to read the Communist Manifesto, including my ancestors, and they rose up in what's called the Luray Mill Strike of 1929. It's one of the most famous mill strikes in American history. It was a disaster for the workers, but they tried to kind of shut the mill down and demand all various demands, and my ancestors were there. My dad voted communist growing up for president. I make I'm a humanities professor, right, at my core. I'm the guy who used to assign the Communist Manifesto on day one of class. So when I started researching the history of financial advice in America, I fully expected to find a long history of Americans being scammed. And after 10 years of research, I was forced to admit I was wrong. Actually, everyday people have been getting ahead over and over in every generation. Capitalism has worked for the vast majority of people in a way that we easily lose sight of. And the craziest thing I discovered in the whole thing was that it's actually been getting easier to get ahead. And so this despair industrial complex that reigns supreme at every point where there is a microphone someone can speak into, everyone's incentive is to tell you that it is broken and wrong, because there are no clicks to be had online. There are no votes to be counted by politicians. There is no tenure to be earned at a university by telling everyone that things are getting better. And yet, things have been getting wildly better for a long time. But that's not a message that you get rewarded for. So part of the reason we think the American dream is dead is because people get rewarded by telling us that.
Is it possible that multiple of these things are true at once? Because, we're sitting here at a moment where, just today, I'm reading about rampant insider trading in Washington and people with, inside knowledge of what's going to happen in the war, or what's going to happen with this or that policy, are literally making billions off of insider information. I mean, it seems like both things can be true at once. Like, right? It is capitalism works. It's never been a better time to be, there's never been a better time to get ahead. And also, yes, billionaires are doing what billionaires have done for, what really rich people have done since time immemorial, which is look after their own interests, help each other out, try and get ahead. But it seems like the knowledge of really rich folks trying to get ahead can obscure this other reality. So it seems possible that both things are true at once.
They are, and they always have been. So let's look at what brings down the Grant administration, right? In the post-Civil War era, it's corruption in Washington, making money off of That's what kind of. It's the reason people don't remember the presidency of U.S. Grant as this huge triumph, because it ends in this chaotic time of insider speculation. So it's been going on forever. I think the thing to remember, though, is for everyday people, let's assume for the moment that there are people out there who are profiting on insider information all the time. What does that have to do with me? Right? What does that have to do with the average person who gets up, gets their kids to school, and wants to live a better life, both for themselves and for their family? And I would argue it has something to do with each other, but not as much as we think, right? Because there's this sense that I'm being sucked into the drama of what's happening on Wall Street and in Washington. But for the vast majority of us, we don't live there and we don't work there. And so I tend to think that if we can detach from that, I call it big woe, right? Everything on the news is big woe. It's like, woe is me, woe is you, everyone is. But if you actually look around you, everyday people are doing better than they ever had. Now, here's what I'm not saying. I'm not saying it is easy for everyone. I'm just trying to dispel the idea that it used to be easier. Because actually it used to be harder. And it used to be significantly harder. So let's take some examples. We have a housing crisis today. This is to your point about both things can be true. We have a housing crisis. We don't have enough homes, and we need to build more. However, it is neither the first housing crisis in America, nor is it the worst. In 1945, the housing shortage was statistically 2 times worse than it is today. A young congressman from Massachusetts ran for Congress for the first time. This was his first campaign in politics. He was a World War II veteran, comes home from the war and says, I'm getting into politics, and he runs for Congress. And his number one platform on his campaign is affordable housing. His name is John F. Kennedy. In 1981, a new mortgage cost 52% of median household income. If you wanted to go buy a house in 1981, it's 52% of your take-home pay if you're the median worker. So we have had housing crises before. We actually know how to get out of it. You build your way out of it. That's the only path, right? It's either demographic decline or it's more housing units. So I'm not saying it's easy if you are in your 30s looking to buy a house and you can't figure out how you're going to afford this. But I do want to make sure you understand, you are not the first person. This is not the first time. And there are things you can learn from the past, from people like you who understand behavioral finance, about how you take all that information in and how you act on the world, because you can get ahead. It's not that you can't get ahead anymore. It's that every generation faces some type of an uphill climb. And how are you gonna adjust to the world you're handed?
Yeah, this is I have a friend and a friend of the show, former guest, who's a sort of a generations expert and talks about the differences between generations. And it's the same sort of pattern. Every generation, is young and idealistic. They grow up, they make some money, they move to the suburbs, they get and then they disparage the generation coming up behind them, right? Yep. They go, oh, well, these guys are idiots. The rising generation is young.
They don't have work ethic. Yeah. And the generation behind them is constantly going, these guys had it so good and you don't understand how hard it is for me. Right. And I'm not discounting any of that. What I'm just saying is you have to understand that you sit in a process that has happened repeatedly. But in terms of generations, let's think about that. The poverty rate today is about 16%. In 1950, it was 1 out of 3 people was technically at poverty or on the borderline of poverty. In the 1920s, it was higher than that. There's portions of American history, the poverty rate is over 50%. The reason the poverty that we encounter today, so you're driving through the city and you look at the overpass and there's families sitting there, it's terrible, and we need to get on that. But the reality is we find it so offensive because it's the least poverty we've ever had. So things do change over time. And they have changed generally in the direction of things getting significantly better. But we're all born into a moment in time. So we're not born looking back over our shoulder. We're born looking into the future. And hopefully that's the value history gives you, is a sense of how far we've come and that you're part of that progress.
So one of the things that I love about talking to a historian is it gives you just, a broader look at base rates, a broader look at what is and how you benchmark your life and how you manage your expectations. With the benefit of all this knowledge, after looking at centuries of financial advice, I want to talk about misconceptions. Right, what do people get wrong about what works and what doesn't work when it comes to building wealth?
Wow, a lot. And so let's kind of step back. And one of the big issues I find is that people assume that if they study the past, and by the way, I say people, I started out this way. When I started looking for these kinds of things, I assumed there was this time in the past that people understood what financial wisdom looked like, and we kind of lost our way. That is not true. What always worked was always changing. Every era's economy is different. And so people create rules of thumb. They create ideas about what works that works for that generation. And then the economy changes and people give the advice from the last generation to the next generation, which is kind of like trying to drive the car looking in the rearview mirror to figure out which way the curve ahead of you is going. Just because that's where it was doesn't mean it's where it's going to be. So let's talk about some of those. One would be our kind of new obsession with crypto, right? This idea that crypto is somehow new. Crypto is not new. Crypto is not the future. It's the past. We have had self-issued currency in America long before we had cryptocurrencies. So I'll give you an example. In the 1840s or 50s, maybe the 30s, a slave runs away in Kentucky. He gets as far as Michigan where he gets stuck and he doesn't know what to do. And so a local landlord says, well, if you want to rent this space from me and set up a barber shop, you could do that. So he does that with a slight problem that he does not own scissors and he has never cut hair. Those problems he could solve, right? He doesn't tell anybody he's never done it and he figures out how to borrow some scissors. But the problem he has to solve that's bigger than that is there's no money in town in Michigan in the 1830s and 40s because there's not enough money to go around. So he goes to a printer and he has the printer print money. A runaway slave self-issues a currency. And it basically says this is good for this many cents worth of a haircut at my establishment. And then he goes and he buys food with it. In essence, he's trading haircuts for food, for lodging. Well, then the people who take those in trade them, and it becomes the same way you can go on and self-issue a cryptocurrency today. And it works. And eventually he's so trusted and it's going so well that he's able to trade this for real money. And this is eventually how he gets out of town and makes his way to New York and freedom. with the slight problem that all that money goes to zero.
Mm.
Right? And this happened all the time. Grandparents would tell their grandkids, whatever you do with money, don't save it. Now, if I told my if your grandparents told that to your kids, like, you'd be like, Dad, don't tell my kid to save, right? But the lesson of money in the 1830s and 40s is money can disappear in value overnight. There were 10,000 separate currencies in America in the 1850s with over 1,000 issuers, some of whom were just individuals. The money from the Holy Roman Empire circulated in the United States for a decade after the Holy Roman Empire fell, because money from a dead empire is better than no empire at all, I guess, right? Like, it's just like there wasn't enough money to go around, and they were just making money up. So we look at crypto today, and like, we've seen this before. Self-issued currencies are only as good as the issuer and the trust in it, and that can disappear overnight. So I think some of the misconceptions are just that some of this stuff is new. There's also things like stocks for the long run. I mean, we hear this all the time, and I know this is near and dear to your industry, so I got to be careful here. I can make enemies real fast. And by the way, I buy stocks. I invest in stocks. I believe in the stock market. I'm not saying not to. But I do want people to understand that our faith in the stock market is actually fairly new. The advice in the late 1800s, early 20th century was that if you were not a professional investor, the one thing you should not own is a stock. For one thing, there was no index in the 1800s and 1900s. If you wanted to buy the Dow Jones Industrial Average, you had to go and buy 100 shares of every company, which would have cost you over $1 million. No one could buy the index until the 1970s. So, and even in a mutual fund, those fees were extravagant in the 1920s, 30s, 40s by our standards today. So our faith in stocks always going up is fairly new. In fact, it's statistically about as old as our last two presidents. The Siegel book that made a lot of that famous, Ed McQuarrie and William Bernstein have gone back and looked at that data, and they found that a lot of the stocks that went to zero were not included. And so if you actually take all of the stocks from the 1800s and put them in the mix, stocks and bonds beat stocks for the whole of the 1800s, and they were tied until about World War II. Mm-hmm. Now, that's not common wisdom today. The common wisdom today is stocks have always beaten everything else. The reality is stocks have always beaten everything else since World War II. That's still significant, but it's not quite what we think. There's also, though, there's misconceptions about real estate. People think that real estate is passive. It always goes up. It's how the really, really rich people got rich. Yeah. No, it doesn't. No, it isn't. No, they didn't. Real estate does not always go up. A home in Pittsburgh, Atlanta, or Houston in 1997 cost the same as it had inflation adjusted in 1897. Now, that's a lot of information flow, but basically the price of a house for 100 years didn't go up inflation adjusted. Now, it's gone up since, but this idea that real estate always goes up, that's also a fairly new idea. It was weird historically for houses to go up. It's absolutely not passive. I own a lot of real estate. It is not passive. It is an active investment category. If you truly invest in real estate in a passive way, then you get passive returns, which is like 4, 5, maybe 6%. But if you want the big returns that real estate advertises, usually that's an active investment. And finally, it's not really how most of the big fortunes were made in America, right? If you look at the Forbes richest people list, it's very few of those are real estate fortunes. So, I mean, I could go on. I think one of the bigger ones that affects people today is just two-income households. Like the idea that two-income households is new. Two-income households are very old. In the 1800s, when you had the first inklings of stay-at-home wives, there's angry letters to the newspaper from husbands saying, "Who told my wife she could stay home? I need her earning." So working families very often had dual incomes. But what happened was the income from the wife was often not reported in a way that showed as employment. So one of the most fascinating ones is just people would rent out rooms in their house, and the women in the household would manage that. It added about 15 to 20% to the family's income to rent out rooms in their house, and women were doing all of that work. So women have always been producing income for the family. It just wasn't always counted. So I could go on, but misconceptions about how it was in the good old days are legion. And one of the things I used to tell students is the good old days weren't all that great.
Yeah. The rosy retrospection that we engage in is wild, isn't it? That stat about Atlanta, as someone who lives in Atlanta and is about to sell his home, that stat about 100 years of no gains is just absolutely staggering.
And by the way, that's from the Federal Reserve. I didn't make that up. That's from the Federal Reserve Bank of Philadelphia.
Well, and, the dual income piece. I think a lot of us, in this age of sort of idealizing and lionizing the past and the good old days and what it was like. And, back when your parents could get along on one income and you could go, the other thing we know, housing has gotten so much better. Vacations have gotten better. The average home size has tripled post World War II. We're not buying the same houses we were buying 70, 80 years ago.
Yeah. They're bigger. They're safer. I think the average home square footage just after World War II, I want to say like late 40s, early 50s, was way under. It's like 800 square feet, something like that. I was right at 900 square feet, maybe. I mean, can you imagine? That's an apartment today for like a single person or maybe two roommates.
Yeah.
And somehow kids found a way to hide cigarettes from their parents. Anyway, right? Like, I mean, people lived a life, right? Like, and I'm not suggesting we should go back to that. What I'm saying is we lose sight of. So yeah, actually, if those prices are inflation adjusted the same, then actually the house kind of got cheaper in a real way. Yeah. You got more house for less. Now, again, if you're 30 years old and you can't figure out how to afford your first house, this feels like, well, what good does that do me?
Yeah.
But what I try to encourage people to understand is the good that it does you is to realize other people were able to act on the world.
Yeah.
And you can act on the world. You can do things that move you ahead. You may not like the things you have to do to move there, in the same way that a whole lot of people were excited to have 4 kids in a 900 square foot house. But you can do things and act on the world in a way that gets you ahead. And Americans have been doing this for 300 years.
Yeah, I think one of the reasons why your work is so important and all the messages that you've shared today are so important is because this pervasive narrative that things are so bad, we can never get ahead, the dream is dead. All this leads to real learned helplessness. It leads to, external locus of control, feeling like you can't just do things, to use the internet speak, right? Yeah. You can't just do things. You can't just make things happen. And I'm hearing from you that you can. And as a very ham-handed segue there, you made things happen when you started your own cryptocurrency. You're talking about our barber friend with his currency. You created your own currency and you were a billionaire for a hot second.
I was, yes. Very exciting. I hollered up to my wife, honey, we're billionaires. And she was like, that's great. Are you getting the kids from track or am I? So to kind of go through that, about halfway through researching the book, I just kind of looked up and thought, instead of just reading all the financial advice from the past, I'm actually going to try as much of it out as I can. And within reason was set by my wife saying, under no circumstances will we do that, right? Like at one point, it's like, what if we sold the house and went and got a homestead? She said no. But beyond that, like I literally at one point Airbnb'd the rooms in my house because this is one of the strategies that everyday people use to get ahead. I invested in a tech startup, which by the way went to zero. So, I've tried out all of these things that people in the past said to do and just to see if they still worked. Well, back to this idea of they had self-issued currency in America for a very long time. And so I thought, well, if they could do it in the 1830s, and if we're doing crypto today, let me try this out. So I went out and I founded a cryptocurrency. The coin image for it was the slave, the runaway slave, the free man that I just talked about, William Wells Brown. And I called it Billionairely. And I made over 1 billion of them. And then I went into a crypto wallet and exchanged a few hundred tokens for a few $100s. And on the crypto exchanges, briefly for a few days, that registered that every single token was therefore worth $1 because all the ones that had been traded were worth $1. I traded 100 tokens, and in theory, that made all the other billion, is 1.2 billion, worth $1 each. And so my crypto wallet was labeled as valued 1.27 billion or something like that. And I sat there and just stared at it. And I called up to my wife, we're billionaires. And she was like, that's great, honey. You have fun with that.
Yeah.
Now, what do we learn from that? A couple of things. One is be very wary of thinking crypto is the future. We've already talked about that. But the other is this idea that net worth is somehow the ultimate game-changing metric we want to use, right? Speaking as someone who has been worth $1 billion and then it went to zero, net worth is a really odd way to try to measure yourself, but including financially. By the way, net worth is a new term. It's a little over 100 years old. This idea that you would have like a ledger on one side with all your assets, your debts on the other, that actually comes out of, there's only 3 times net worth matters. It matters when you want to borrow money. Can you pay us back? It matters when you die. Who's going to get this stuff? And it matters when men want to impress each other. There's no other time that it's a relevant stat. Because unless you're dead or borrowing money, net worth is not something you eat. It doesn't earn, right? It's just this sense of what you're worth. And it's an entirely new concept. No one would have understood this in the 1850s. No one would understand. They've talked about having an estate worth, but the only thing they meant was how much money does it churn out that you can actually spend? And as most Americans know, their primary asset is probably their house, and that costs you money every time one of you watches HGTV. So it's not like the house is in the net worth equation for some people, and obviously not, depending on what equation you're talking about and high net worth individuals and all that stuff. But net worth is an odd thing to chase.
What was the conceptual shift that led us to chase it? What happened?
That's a great question. So the first thing that happened was the idea itself came out of measuring businessmen. So like, isn't Carnegie still kind of Andrew Carnegie, right? Like this obsession with the early millionaires, which we would now call billionaires, and trying to figure out what they were worth. And then it actually came out of tax law. So there were these, when you first get the income tax, all these rich people start evading it by putting stuff into assets that aren't churning out income or is not registering it. So it goes all the way to the Supreme Court, and the Supreme Court says, yes, you can actually look at someone's net worth to decide if they're hiding their income. And by the time the Reagan administration comes along, there's all these advertisements inside of banks and marketing firms, like going after high net worth individuals to try to sell them Rolexes and this kind of thing. In fact, this is where we get that famous book, The Millionaire Next Door, because everybody reads that book and thinks, oh, if I want to be a millionaire, what I really need to do is drive a Toyota, right? And live in a ranch house with 3 bedrooms. What that book actually is about is how do you sell stuff to these millionaires who are so cheap they won't buy stuff. Because the authors are marketing professors, and they were trying to figure out, how do I market to these millionaires? I know they've got the money, but they won't buy anything I'm marketing to them. And so this obsession with marketing to high net worth individuals, then that by the 80s, that just took off, and it was in movies and media and news outlets. And so it's how we talk about it, but no one talked about that. George Washington didn't know what he was worth. That was not a thing that bothered him at night.
Yeah, again, just such great perspective to have. I find it so strange when people sort of obsess over this and report it publicly and track it so fastidiously. At the risk of romanticizing the good old days, maybe we were better when we measured our lives, with a different yardstick than, not that wealth hasn't always been important, but it seems like there's better yardsticks for measuring a life than net worth. Let's keep with this theme of these ideas that you sort of tested on yourself. We love an author who's willing to eat his own cooking. So you created your own crypto, which incidentally, I did as well. Mine was called Voltron coin after my favorite.
Yeah, we are of a certain generation, because I knew exactly what you meant.
After my favorite multi-headed robot there from my youth. But because of because of compliance restrictions and stuff, it never saw the light of day. But I just went through the process of creating it just purely as an instructional piece when crypto is taking off. Sort of feel like you need to have an opinion on how all this happens. And just even the creation of that coin really humbles you and makes you realize how easy it is to do this, and how wary you should be of scammers. But any other experiments worth noting that you undertook?
So I mentioned I Airbnb'd every room in my house at one point, which that was a crazy experiment, right? Because at one point I ended up having to sleep on the couch because I overbooked. But this was what people did. Like, this is one of the things that there's a couple of the book I discuss, William and Agnes Taylor. He's a police officer, and they bought a brownstone in New York. Now, it wasn't the prices of today, but they still weren't cheap. And the way they afforded it was renting out all the rooms to pay the mortgage for 8 years. And so I just was like, well, what was that like? So if it was, I'm just going to try to experiment with it. There's a huge note. There's a real estate investing boom in the 1940s and 50s because of the housing shortage, right? That they were experiencing then as we're experiencing now. And every generation kept getting closer and closer to how little money can I put into real estate. And by the 1970s, there's the first book that says you can buy money with zero money down. And by the early 80s, a guy writes a book saying not only can you have no money down, you can actually kite the check. This is back when checks processing took a long time. You could kite the check at the closing table. When you leave, they will hand you the money from the security deposits, and you're going to deposit that to make sure the check doesn't bounce, which is, by the way, illegal. But this was a best-selling book in the 1980s. So I didn't do that, but I did try, like, what does it actually take to buy real estate with no money down? I bought several of those. That led to all kinds of craziness, including having to be on a conference call with the FBI because one of the people who rented the house was doing human trafficking, and we reported it. And then the FBI was like, well, will you sit on this house so we can, instead of evicting them, can we just watch it so we can track them? And we said yes, which I'm glad I did because they caught them, but they caught them in other houses too. But also it led to me, having to go and repair like $20-something thousand of damages that they had, inflicted on the property. Now, please, I would ask all of your listeners, don't do that. But the idea was like, okay, this is something that thousands and thousands of people tried because they wanted to get ahead. And I want to understand what it is people were trying to do and why they were trying to do it. And the reality is the less you have, the more desperate you become, right? And so we have all these methods of kind of desperation. And we also, by the way, have the bankruptcy records of Americans. And one of the primary ways that people went broke in America was being untrained in what they were doing. In fact, it's one of the key themes in bankruptcy reports of the 1800s is that people very simply had no experience in the business they were trying. And so one of the real lessons of that's what the title of the book is, like, what worked and didn't. One thing that doesn't work very well is trying something you have no experience in whatsoever. If you're going to go off in a new direction, go, but do that with some training and tutelage in that industry. You get really, really good at it so you can make the money that is there.
Yeah, overconfidence is as old as this great nation itself. We're running short on time, but I don't want to miss this idea of fast time and slow time that you introduce in the book. Can you tell us about that distinction?
Yeah, so I've read a lot of history, and when you read financial history, you realize after a while that most of the books that people read about history are what I call fast time history. Everything is changing everywhere all at once. All the assumptions are being undone, and all the smart people saw it coming. And there's this sense that you should constantly be looking out for that, right? But that is not most of financial history. Most of financial history is actually pretty slow time. Everything churns along within a range of volatility that's pretty normal. There's always somebody saying it's going to crash and always saying somebody saying it's going to boom. And usually it stays within a bandwidth. Fast time history is not written to inform you on how to invest. Fast time history is written to entertain you. It is a murder mystery where we are reading and looking at the people in 1929 or 2008, and we're screaming at the screen, he's behind you. The subprime mortgage lender is behind you. Run away from the mortgage, right? Like, it's there to get us excited and entertained, but it's not really teaching us what to do with our money. And if you think of all financial history as constantly being in fast time, then you don't really understand what is happening in financial history. Most of financial history is done in slow time. It is what you choose as your profession, who you choose as your spouse, which, by the way, the number one piece of financial advice in American history, who to marry. That was the number one thing people would talk about. Before you work about what you were going to do, who are you going to marry? So who are you going to marry? What are you going to do for your living? What are you going to get addicted to? Right? Because that's going to happen. When fast time comes, it rewards the prepared. But fast time is rare. And you may live through it once, maybe twice in your life. Most of your life is going to be lived in slow time. And so you have to kind of don't avoid the doom and gloom stories that are exciting to hear, but not necessarily relevant to how you're going to live your financial life.
Yeah, everyone's always so busy preparing for the black swan, that they get all the blocking and tackling along the way.
Exactly.
That leads you to be successful. So I think all my listeners will see why we hit it off so much, why I'm so excited about the book. Tell us when the book comes out and remind us of the title one more time so folks can go out and cop it.
Yes, I hope this will be a useful history for people. I think that's the biggest takeaway. I hope this is a history that you can read. It's fun, it's engaging, but it's also useful. And I hope that that's something that people get real value out of. The title of the book is How to Get Rich in American History, 300 Years of Financial Advice That Worked and Didn't. By the way, the title is from all the books in the 1800s. There was a whole swath of like how to get rich in cattle, how to get rich in candy making. These were everywhere. That's where the title came from. So How to Get Rich in American History, and it comes out on April 28th. And I certainly hope it'll be a useful history for your listeners.
Well, everything we've heard today, I think so useful. So it's that rare blend of entertaining, informative, and applicable. It's been a pleasure to have you on the show. Best of luck with the book, and we hope that everyone will go out. I get on the soapbox from time to time. I think, I wrote about it in The Soul of Wealth. Spending money is a vote for the world you want to live in, and I want to live in a world where smart and kind people write books that help other people. So go out and grab Joseph's book. Dr. Moore, great having you on the show. Thank you for joining us today.
Really enjoyed it, Daniel. Thank you so much.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.